Good morning. Today we are doing I say we because Dave's going to join me about 2/3 of the way through the session. This is the Mindset Meets Mechanics session. And here we're talking about real money, real life portfolios that I run, which are real money portfolios, in the public portfolios, which was what we call them. But now we've also got some Learn to Trade Properly study group portfolios. There's 4 of them going. And they are real money because you, our customers, are running those. And I've scanned through the names that are attending today, and there are a lot of you on the Learn to Trade Property study groups. And those that started in September will know what's happening with your portfolios that you're running as real money. We'll have a look at those, and we will also go through just a little bit of analysis, if you like, the big picture, what's happened in the market while these portfolios have been running, and a little bit of repeat from a month ago when we spoke. Just looked at a discomfort zone, but I'm going to zoom a little bit more in that and just look at how the portfolio performed in that time, rather than just talk generically about it. That's the ASX portfolio, which had a bit more trouble than the US portfolio during that time. And then we'll open up to questions and answers if you want to. Right, before we do this, we have to tell you that everything we cover here today is general investment advice, not a specific and personal investment advice. Okay, I've got a quote for today, which comes from Jim Rohn, and I think it's most apt. We must all suffer from one of 2 pains: the pain of discipline or the pain of regret. The difference is discipline weighs ounces while regret weighs tons. And I think that's most apt given what is happening in the markets at the moment, and what I'm going to talk about with people that did not have the discipline to continue executing through the tough time on the ASX, and then may have some regret now for not having done that, because those who stop during drawdown and don't continue trading stay in drawdown forever. You have to, at least at some stage, engage the game to come out of drawdown. And what people suffer from, and I think this is a bigger problem than going into drawdown, is coming out of drawdown. And that's what we're going to talk about today, because you can only come out of drawdown by engaging the game. Right, the portfolios we're going to look at are the ASX Investor, Sparsely Investor Public Portfolio, and the US one. And then there's also a leveraged one, which we keep an eye on as well, and just look at the volatility, the additional volatility that comes with that. And we'll be making some announcements in the next 3 or 4 weeks about that as well. So our objectives of doing these sessions is to look at warts and alls, and today there's certainly going to be some warts that I'm going to look at, of real world trading conditions with real money under the pressure of having real money at stake, and then being able to execute as you should, as if you didn't have any money at stake. And we talk about mindset, money management, not just timing. And we also, I just made that point, it's all about executing under pressure as you should. Right, we've also got 4 Learn to Trade Properly study groups now. The ASX one that started back in September is there's an equity curve that's starting to look a few months in there now, and it's some ups and downs, and we'll look at that. And Dave will join me for that. We'll also look at the US one, which started on the 9th of December. And for quite a few weeks, there were no trades that came up there because the US market was going down. So there were no entry signals, but it's got some open trades now. And 2 recently started ones on both the ASX and the US, which have only been going for a couple of weeks. And we can see how these worms, these equity curves, start and keep going. Let's look at some recent performance in the S&P 500, just to put into context what's happened. You heard me talk about this period over here, which was a drawdown. So the S&P 500 fell. So we're going back here to August of, this is January of 2022. And then we had the sideways down, rising, coming out of making a new all-time high. And this market, from that breakout here, which is the same high as what was achieved over there, it's up 27.5%. looking at the ASX, there's the sideways moving, same time period. This goes from August of 2021, so it actually was a bit later. But how much has this grown from its high? It's grown just 10.9%, say 11%. So a long way behind what the US market achieved. And this is what Dave and I spoke about last month in this session, the portfolio consideration session, this discomfort zone of 3 years of sideways markets. And now we've had this breakout on the Australian market, and that is followed through in our portfolios. It's just amazing how people think that they're going to get a growing portfolio that's going to be rising at 45 degrees when the overall market, the environment in which you execute, is doing this, and then they wonder why it's not, their portfolio is not rising. Right. So let's just zoom in on that discomfort zone period, that sideways movement. Now you can see that the peak was achieved back here on the left-hand side, and then 3 years later, almost exactly 3 years later, the ASX200 or the All Ords, whichever you want to look at, was at the same price. And even though there'd been a breakout, it had come back into the and found support to the zone breakout and came and found support again. So resistance, support, and support, then eventually it broke out. But the 3 years later, you had the same price in the index. So what happened in the portfolio? So that is the line chart. The black line is the line chart of what I just showed you in the previous chart, which is the All Ordinaries or the ASX 200, much of a muchness. In fact, this is the ASX 200. There, it's at the same price, August. And this is the SPA3 investor real money public portfolio and what it did. Sure, it's not good. And it generally goes in the same direction. Sometimes a little bit more, it falls by a little bit more than the All Ordinaries or the ASX 200. Here it certainly did. And that's it's painful enough being in drawdown. And when your portfolio is rising while you're in drawdown, it's a far better feeling than when your portfolio is falling while in drawdown, falling by more than the market. This is painful. This is uncomfortable for people. It really is. And that's when we get tested. Now, why am I making a big point about this? Because in the Learn to Trade Properly study groups, we actually look for periods like this. Why? Because this game is about, in the short term, experiencing pain, but overcoming that pain, that emotional pain, that discomfort, that disillusionment, that disappointment. Because the degree to which you can do that is the degree to which you're going to be successful in the markets, because anybody can handle a rising market. Anybody can. In fact, you can probably, even if you didn't have a system, you could probably pick a few and just let them run, and it'll make up for the losers that you have. But to be able to survive, to be in that environment, you have to be able to put up with times like this. Because if you can't put up with times like this, you're not going to be around for the times that rise. And you can take that analogy that I'm using in the market and apply it to anything in life, anything. But somehow people don't want to live that in the market. You have to. There's no other way. So in the LTTP study groups, we actually want periods like this. And the skills acquisition plan is set up such that you need to go through 2 of these and experience them, and then to apply the discipline with effort and with almost forcing you to, yourself to do it, which is what discipline is. It's enforcing you to do something that you don't like to do and something that is a bit uncomfortable for you to do. That's what discipline is, and that's what Jim Rohn was talking about. But it weighs ounces compared to the tons of regret of not doing it properly that you eventually feel if you didn't do it properly, if you didn't apply the discipline to do it. And you can think of other parts of your life where that has happened to you. So this is the period you want to get through. So this is a warts and all presentation. This was real money. This is my money. For 3 years, we sat there. And I know we had lots of discussions with customers, and they got disillusioned, disappointed, and couldn't hack the pace and stopped. And now we're seeing some of them coming back. And when I'm talking to some of them, I'm saying, oh, look how's the portfolio done recently? I show it. And they go, well, how did it do for the 3 years prior to that? And I go, well, it battled. And that effect that it has on their decision and what to do, tells me, having been doing this for 35 years nearly, is it gives me an insight into where they are on their trading journey. Because you are a long way down your trading journey if you accept the risks. That's the first step to being able to do this caper properly, to trade properly, is accepting these risks are going to happen. 100% dead cert they're going to happen. And then what you're going to do about it to actually trade properly. Now, and I'll show you what happens since then, that period, since August of 2024, which is where the 3-year period ends. But, also what we do is we don't benchmark ourselves against the ASX200 or the All Ordinaries Index. We benchmark ourselves against the ASX200 Accumulation Index. And a lot of customers say, well, why do you do that? Because we've got we're a long cash strategy. We're not a shorting strategy, but also we don't get all the dividends. We only get some of the dividends, although they do play a fairly big role in the Australian market compared to the US market. But we benchmark ourselves against the ASX200 index, which we know from long-term research from the SPIVA scorecard that 83 or 80, I think it's 83, 85% of active funds, equity funds, not balanced funds, equity funds underperform the ASX200 accumulation index. And we know in the US, that's over 7 to 15 years is what the data is showing. So longer term, the longer the term that goes, the higher the probability that an active equity managed fund is going to underperform the index. And we know in the US that sits at 93% of active equity funds, not balanced funds. Equity funds, balanced funds do worse than equity funds over the long term, underperform the S&P 500 Total Return Index. So if we are matching or slightly better than the ASX, than either of those total return indices, we are right up in the upper echelons of people who actively manage money in the market. And of course, those who aren't active, who are passive, have got their money with those active managers who are underperforming the market. So we benchmark ourselves pretty strictly and stringently against the ASX 200 Accumulation Index or against the S&P 500 Total Return Index. Now, coming out, so the bottom left over here being August 2024, when we had those 3 years of sideways drawdown market. And this is what the real money ASX public portfolio has done since. So sitting at 24.7 compared to the accumulation index at 12.9, say 13, and the black line there is the ASX 200. That's without dividends. Obviously, over a shorter period of time, the gap's small. The longer the period you look at, as in this next chart, which is now since inception, the black line here is the ASX 200 without dividends. The red line is the ASX 200 Accumulation Index with dividends. And the blue line here is the real money public portfolio using Sparse Reinvestor. And here we are about 67, 68 percentage points higher than the accumulation index. But there's 2 periods here, and you might even look at the blue line and think, hey, this looks like, some of these longer term index equity curves, if you like, that we've looked at, like the S&P 500, when I do, the long-term secular bull market update, you see those long secular bear market periods, right? Well, this is a shorter period of time. It happens in equity curves as well, believe it or not. Equity curves don't just keep on going up at 45 degrees from bottom left to bottom right. And that's where we get this. That's why I talk about all the time about a big picture perspective and having a neutral mindset and stepping back to seeing your edge over the long term. Mark Douglas used to talk about a large sample, right? People ask, how large is that sample? Well, I can't give you a definitive answer on that because that's out of our control. That's in the market's control. But what we can control is our edge, our flow, and how we execute that edge in the market. And that's really, it comes down to being a game between our ears. But the bit that's not between our ears is the edge, the objectivity of doing this. And even with an edge, we have sideways moving periods like we did back here in 2017 and 18. And there were periods of underperforming. You can see the equity curve, our equity curve fell, market went sideways. We rose by a bit more, fell by a bit more, rose by a bit more, fell by a bit more. And then we had this breakout. And that was a magnificent run. It was over 100%. Our portfolio grew. And guess what? Just like you'll see on a chart is, almost the longer and the stronger the trend, it's going to be followed by, a sideways consolidation period. And hey, guess what? It happened in the edge as well. It happened, in the same way as it happens with with companies whose equity prices you see in a chart. They have these big trends, and then what? They consolidate. Well, the edge of their business, the edge of how they operate in their environment of the marketplace does the same thing, right? So why do people expect an equity curve not to do the same thing? They just have this expectation, and which is why we spend so much time talking about James Clear, is that we expect this reward into the future. And the more energy we put into expecting this reward into the future is directly proportional to the amount of emotional pain we're going to feel when that expectation doesn't come through in real life. So, James Clear talks about, we've hardwired to expect that. So what we got to do, you can go through the rest of your life doing it, but what you do in one thing is you do in everything, is that we've got to reframe how we think so that we don't have this positive expectation of reward all the time that's going to come to us from the future. We have to step back and operate in the now moment and disassociate with the past and break off expectations projected into the future and execute in the now moment and to stay in the flow. What is your flow? Flow equals edge. Edge is not perfect. Perfect doesn't exist anywhere on the planet, and edge means probabilities. Probabilities means you're going to have losers. Probabilities means you're going to have drawdown. And it's up to us to psychologically set up our wherewithal in this environment in which we operate to be able to withstand the adverse times that we've got to get through to survive those times so we can thrive when the edge and the flow is in sync with the market, with the environment again, just like any business has. No business just thrives 100% of the time, and just has massive growth nonstop. Doesn't happen. So it won't happen in your equity curve, won't happen in your life and anything else you do, whether it's a golf course, a relationship, or whatever. There are ups and downs, and you have to be able to survive the downs to be able to enjoy and appreciate the ups. So that said, lecture over. It's you can outperform, but to be able to outperform, you have to trust the edge to start with, the objective part of your analysis. That's what you have to have in place, and you have to trust it. And as I posted on the forum, that is more a decision than a growing thing. You have to decide to accept the risks. Step number one on the path to consistency. You have to accept the risks in the market because you can't control them. You then have to have an objective flow, an objective edge, and an objective decision support system that operates that environment. And you have to accept that and trust it. So the first three steps of acceptance, of objectivity, and of trust are a decision. They're not a growing thing. And you can decide to develop your own objective edge, or you can use one that we have. Up to you. I don't mind. But unless you trust it, you are not going to gain the confidence. Step number 4 on the pathway to consistency. And without acceptance, objectivity, trust, you will not get confidence. Then when the confidence comes, and I agree that will grow, but without the first 3 steps in place, you will never achieve consistency, which is the target of what we're trying to achieve here. And then with that consistency comes profits. Profits don't just happen on their own. The first 5 steps on the path to consistency, 4 steps to a path to consistency, and the 5th step being consistency itself, have to be in place to be able to get the outcomes. So I'm putting a lot of emphasis on that period of 3.5 years. Now, I couldn't do that while we were in it because people wouldn't believe me. Well, now we are out of it, and you can see we've made a new high over here. Is that high are we going to go back into the range? I don't know. I have no idea. I don't need to know what's going to happen either. And Mark Douglas talks about, the skill of not knowing. If you're trying to know all the time, you go out of the flow. Not knowing equals you stay in the flow, because trying to know projects you into the future, and suddenly, James Clear, you have an expectation of a positive reward in the future. When it doesn't come, degree to which it doesn't come, and the degree to which you expect it to come is the degree to which you're going to feel emotional pain. And that's what we are trying to overcome, because emotional pain makes you indecisive. It makes you hesitate. It makes you uncertain. It gives you all those awful feelings that we are trying to overcome and teach ourselves to overcome, and to reframe how we think with respect to trading, which means we've got to learn to think from the perspective of the market. How do we do that? 5 fundamental truths, 7 principles of consistency. repeat them every time. And this is an exact example of what's happening right now as we live this, which is why I've got to emphasize it now and capture it now on video. And for those of you that are listening today, to get it now, because this is when it's happening. We are transitioning to new all-time highs in our portfolios if you had stayed the path and actually kept executing, like this particular comment from somebody who put this up just on the 17th of February, Adrian. With no belief/mindset edge, the proven mechanical system is useless. This has been proven to me with my ASX portfolio started in February 2020, just prior to the COVID crash. Initially, the portfolio was saved from a large fall, then with some upside. However, was sideways to down since around July 2021. During this time, I considered exiting the ASX market, but in the end, trusted the system, which was a decision because certainly Adrian wasn't getting feedback from the environment to trust it. That was a decision. The trust, if people are looking to build trust, you'll never get there because there's always going to be plenty of evidence to break your trust. It's a decision to trust, not to let the environment prove it to you. You have to decide to trust. And trusted the system and kept executing. Now, after just over 3 years in drawdown, the portfolio is at all-time highs. In summary, no belief equals no achievement. Thanks, Gary and SWS team. Also, a similar story with my US portfolio started in August 2018. In summary, no belief equals no achievement. Belief/faith, if you like. Belief implies that you don't have 100% evidence. Is that what you need? Do you need 100% evidence before you trust? It'll never happen in any environment that you operate, in any situation. And Mark Douglas talks about, the uncertainty principle. Uncertainty will never go away if you are trying to prove certainty. You can't prove certainty, but you can get certainty over a large sample. So the uncertainty principle states that in the short term, there's going to be uncertainty, there's going to be randomness. But over the long term, with an edge in your favor, that's how you get certainty. But the only way you're going to get that certainty is if you trust and believe in the environment that you're operating in, that it does provide opportunity, that you trust in the edge, the flow that you use, and then trust yourself to execute it. And that means that you are going to have to not know what's going to happen. You can't play this game by having to know what's going to happen, because it's impossible to do it. You can't know the future, which means you have to live through this not knowing what's going to happen. And that means you can't project into the future. The moment you project into the future, you're looking for information all over the place to try and give you certainty in this individual trade every now and then. It's impossible to achieve. You will never get there, which means you'll never learn to trade properly if you think like that. Okay, keeping on going. Let's have a look at the US now, some relative US portfolio performance over the short term. And I'm going back to the 24th of June here. Same thing, US public portfolio outperforming 33.9% versus the total return index of 13.5, some 20 percentage points outperformance over the last, 7 odd months. Let's look at going back to September 2022. So we're talking about, 2.5 years here. Did I put it onto there? Yeah, so the black line over here, I put a black line. That's not the you can see the shape is different. That's actually Berkshire Hathaway. So I thought I'd put in Warren Buffett and see how he's going over this period of time. And just in the last 7 months, he's kind of matched the S&P 500 Total Return Index. And over the last 2.5 years, this is the type of portfolio performance that you can get using SPA3 Investor. Is there better out there? Sure there is. And I'll show you one in the moment. You can use leverage if you like, or you can go to, really speculative market environments, and you can spend, a huge amount of time, and just analyzing and spending your whole day, analyzing and reading if you want to. You're sure you can get better than that. But I challenge, if there's many other systems out there where you can spend 15 minutes a week once you've got the skills to achieve this kind of performance. So in 2.5 years, nearly doubled, 92.4%, when the total return index has got 73.6%, and there's Berkshire Hathaway kind of, sometimes matching, and sometimes it outperforms us, and sometimes we outperform Berkshire Hathaway. But that's pretty good performance if you were still in the market at September 2022, because leading up to that period of time, it was pretty horrid. That's what it was. That's what we went into drawdown. We went into, I think it was off the top of my head, 33% drawdown, and that just shakes the people who haven't learned to trade properly. That shakes them out of the market. The market's always going to test you. The environment's always going to test you. It's up to you as to whether you can withstand that test or not. And the way the market tests you is through chucking lost trades at you and chucking periods of drawdown at you. And you have to have all of the path to consistency, as I said earlier: acceptance, objectivity, trust, confidence, and consistency to be able to thrive when the market gives you the opportunities to. And that means you have to stay in the flow, not associate with the past, not project into the future, execute in the now moment according to your edge. So this is, are we underperforming over the last, against the S&P 500 Total Return Index? Sure we are, but we would be beating 90% of equity funds out there in the US over this period of time. SPIVA tells us that, right? And we are, 0.9 of a compounded percentage point. That's what I'm measuring here. That's compounded annual growth return, or annualized return, over that period of time. Now, the real thing here to worry about is at some stage on the US and the Australian market it's sometime in the next 1 to 6 years, we're going to enter into a secular bear market again. And when we enter into that period of time, then having a cash long equities system means that we're going to spend a lot more time in cash. Our exposure percentage is going to drop. And when we get into that environment, we are going to massively outperform the indices, and we're going to protect the growth that we've got. And we're going to see these indices just keep going, to like in 2001, 2, and in 2007, 8, 9, there's going to be 50% falls in indices. And that's in total return indices as well. And maybe even another 80% in the NASDAQ. And that's where we're going to protect and preserve our cash. And that's where, buying and holding index ETFs is going to really test people, particularly people in the latter stages of their investing career. So, sure, we're slightly underperforming, but I know that we are set up to outperform in the future and to go into cash when we need to. Right, just quick US leveraged, the relative portfolio performance on the leveraged, and I'm taking this from September 2022, so the same as the previous, not the previous slide, the one before that. So this leveraged portfolio is up 422% over the last 2.5 years, and it just made a new all-time high overnight in the US market. Had a couple of big rises there. I think Intel, which has been a massive underperformer for some time now, I think it had a big 16% day. So that's, obviously we're using leverage here. So you can choose to, if you have a speculative streak in you, you can take some of your money and you can use SPA3 Investor and leverage large cap stocks rather than going and looking for highly speculative, highly volatile stocks. You can create your own volatility using leverage, and that's what this portfolio has. That's what we're doing with this portfolio. And I do tell you that this portfolio has been an experiment on my part to really nail this leverage trading environment, and we'll have some more to talk about over the next few weeks. Okay, let's look at sells over the last month. The sells over the last month on the ASX, there was one at 5% loss. There was one on the US Caterpillar, so that was TCL Transurban. On the US public portfolio without leverage, Caterpillar 6.41% loss, and US leverage also Caterpillar, and that's just because the brokerage made up a bigger portion, if you like. I think that's why there's a difference there, because the entry and exit dates were the same. Sells over the last month in the Learn to Trade Properly September cohort study group. We've had 3 sells over the last month, 12th of Feb, 11th of Feb, and 20th of January. 1 profit trade and 2 lost trades. CSL breaking that 10% that we call that we talk about as being a stumble. On the USA December, which 9 LTTP that started back then. We've had 1 Caterpillar, and that was on the 3rd of February. On the other two LTTPs that we're going to talk about, we haven't had any sells in those because they only started a couple of weeks ago. Some recent stumbles, CSL, recording greater than a 10% loss for an individual trade, a stumble. There weren't any on the other two portfolios. There haven't been any recent ones. Recent leaps, let's look on the ASX. JB Hi-Fi, open trade, 56.6% profit. Aristocrat, 50.3% profit. Computer Share, 45.8% profit, all open trades in the public portfolio at the moment with real money. On the US public portfolio, American Express, 106%, and Fortinet, 66%. And Axon, we closed in January, a 56.6% profit trade. That's what the orange means. It's a closed trade. In the leveraged portfolio, we've got some similar ones here. American Express, Fortinet, and Axon are three from there, but there's two others here. United Airlines, we got into in the leveraged portfolio. That's also up 105%, still an open trade. And Take Two, nearly a 50% profit trade open. So those are some recent leaps and stumbles. Okay, I'm going to cross over into Beyond Charts now. We're going to look at some, it's just some periods of performance, just relative performance. Going to look at some equity curves, and I'm going to switch into Beyond Charts right now. Let's start off with the ASX public portfolio. I've already put this in. We're going to a year ago, 2024. Dave's going to join me now and make some comments as we go on the Learn to Trade Properly. Let's make some room here. Here we go.
Hogging the camera
both in there.
Yep.
Okay. So over the last year, the public portfolio is about 0.3% behind the ASX200 Accumulation Index, so 14.4%. I'm just going to also check. We'll go back and have a look 3 years. Let's go 2021 and just see how that has gone. Slight underperform. It's about half. Now, these are compounded annual growth return or annualized return numbers. So over 3 years, underperforming, and that's right in the middle of that discomfort zone that I was talking about earlier. We're measuring from, so that takes up a big chunk of that. And we will do 5 years, 135, pretty typical. Let's make that 18, I think. See if we can get closer to 18. Yeah, we do. So about line ball there, much the same over 5 years. And we'll do 7, 2018. And yeah, we outperforming then over certainly over that period. Now that's got that big run up that we had after the sideways movement, and that's got the 2019, 2020 run up in it. And so outperforming there by 3.2 odd percentage points. And then since inception, about 3.15 outperformance there. So that's just taking snapshots. And obviously when we run these sessions, we're going forward in time. So the snapshot we're going back to is changing. And that's really how, the funds business does it. We'll quickly have a look at the US market over the last year, 28 point versus 24.8. So 3.5 percentage points better there. Let's just go back. I won't spend, just go to 2018. We'll do the 7-year, underperforming over that period of time. And we know that even since inception, we 0.9 of a percentage point behind as well. So with leveraged, we are getting way out performance because that's what you do with leverage. And I'll quickly go back, and without spending too much, we'll go back 5 years, 2020, and we should be I'm just going to do 3 years, 2022. 2022 and underperforming because we obviously had the big drawdown, and we'll go back to inception and we are underperforming. So that is, and you can look at those equity curves. You can download all three of these portfolios into your instance of Beyond Charts, and you can have a look at them. Right now, we're just going to quickly go over to the Learn to Trade Properly, and we're going to start with the Australian ASX. Started 20 September, and right, what have we got here? We haven't got that there. Somehow this has all got mixed up a bit. There we are. That's got okay. So I'll hand over to you, Dave.
Yeah. So this is all starting back in September, and again, those people who are part of that group contributing really, really well, and comments, etc., and making lots of progress along the way, and creating that new identity that you talked about a little bit before, Gary. Really important, and accepting the risk. You also touched on as well, and I just wanted to reflect a little bit about those equity curves that you've just shown there, Gary. That when the market starts to get a run on, it's surprising how quickly those public portfolios can really put a lot of hay in the shed. So whilst it's very difficult and challenging for somebody who hasn't quite got the right mindset through those ups and downs, the sideways movement, etc., by remaining in the flow and really working hard during those times, means that you get to see the benefit of remaining in the flow. And I think that's what Adrian was pointing out in his comments there. So for all of you that have gone through and struggled through those sideways markets, and you're still here, hats off to you. You've obviously got some key attributes that are going to make you very good traders with a little bit of fine tuning. And that's what Learn to Trade Properly is all about. And that's what we're discussing here at the moment. So this is a portfolio that started back in September. And it actually hasn't been a whole lot of activity in that portfolio over that time. It's been fully invested for a little bit of time, but more recently it's had a couple of sales. Now, if you have a look at that portfolio, you'll see there that even though it's a small window, there's been periods of drawdown, and we've got to understand that drawdowns not negotiable. It's something that we're going to experience. Okay, so we just need to understand and put that in context. Okay, and what you'll see there on the right hand side, that it's actually just come out of a period of drawdown. Now, one of the skills that we're trying to establish is the benchmarking our skills. So how do we know when we've arrived as a trader? So we often talk about being calm and peaceful in all market conditions, so regardless of what the market is doing. But how do we quantify that? So we look to be able to trade through periods of multiple 10% plus periods of drawdown. Now, we've only had a drawdown there of a little over 5%. So we're really only halfway to really kind of first base. I really, when we think about it, we talk about a baseball field, you might have first base might be a 10%, second base might be 15, third base might be a 20. If we have to go to 25 as an example, well, again, we're going to need the right sort of mindset to enable us to trade through that. Like Adrian, just one example of many, like the public portfolios, again, other examples, to be able to get through those tough periods in a calm and peaceful manner. So the concept here is really important to understand, that we're trying to teach members how to be able to trade through those periods that are just, they're going to happen. They're going to happen. It's a dead certainty. And that's what you mentioned before, Gary. I really like the idea that there are no, there is, perfection doesn't exist. There are risks everywhere. And truly accepting risks is really important. And whilst we talk about this in terms of trading and investing, we have to be able to do that, because if we don't truly accept the risk, then how do we ever establish faith and confidence and trust and consistency? You can apply that to any area of life. You walk out the front door, there's no guarantee that you're going to be able to walk back in that front door 2 hours later. There are all sorts of things that can happen. So we have to have the mindset, the skill set, the awareness, the wherewithal, etc., to be able to exist in our environment. And it's the same here. So we've gone through a little period of drawdown there. Going through there is important. Getting feedback from the group is important as well, and sharing concerns or issues or just topics to raise, because that's how we learn. So members who are out there on their own get benefit from being in a group. So obviously I'm plugging the group, absolutely, because there is so much to learn from a community of like-minded people with ultimately the same goals, that we all want to be able to learn how to trade in a calm and peaceful manner, in an active fashion, regardless of what the market is doing. So like Adrian, like a number of others that I can see watching today, like Wakefield, who's made many comments on the forum over the years in the past, just gets on and does it because he truly accepts the risk. And that's what the program's about. So here it's a small window. It's a small sample size. So again, we have to think from the casino's point of view. We have to have a casino mindset and be thinking long-term perspective, and that there is going to be randomness and uncertainty in outcomes in that short term. And yet you wouldn't find a casino that had a bad day, a bad week, a bad month, or even a bad year, close up shop and go, you know what, we're no good at this, let's stop, okay? Because they know that they have an edge. So they get to see remaining in the flow, trust in the process, having faith and confidence, going through those periods of drawdown, so that ultimately, over the longer term, that's how we create the certainty. Yep. So there's a randomness in outcomes in the shorter term, but over the longer term, the edge, and that's why I love coming in these sessions, because I get to see the public portfolios discussed. And these are mini public portfolios, but they are real portfolios. And I think that's an important concept for everybody to understand.
Absolutely. And, there's around 50 of our customers, some who are watching today, that are actually, those are the equity curves.
Yeah,
and they're doing it with, with different amounts of money, but this one is just 36K. Some people have got a little bit less than that. People have got a lot more than that but that would be the shape of their equity curve. And, now this is not, we didn't invent this idea. I'm sure some of you know that have read Mark Douglas's book, Trading in the Zone, that this comes from exercise that he has in the back of Trading in the Zone, which and I've written about this and we've spoken about that. We know very few people do on their own because it's hard. It's hard to work out your own mechanical system to start with, because that's a prerequisite to doing the exercise. But it's also then hard to go and do it on your own. And that's why what we've done is slightly modified that concept that Mark came up with. And we're doing it in a group, in a study group, if you like, or whatever you want to call it. But we've also varied the objectives of it as well. It's not just to do 25 trades. This portfolio has done 16 so far, and then I think you add the open trades on as well. So we're sitting at 16 completed. Probably it's not. That's not the case. I think that's 16 in total. Yeah, those are closed. So that's 16 in total, closed and open. And so we haven't got to 25 trades yet in the context of what Mark spoke about in the exercise. But the really important bit that we've added to that as an objective of doing the Learn to Trade Properly study group portfolio, which is in the skills acquisition plan, which you learn about in the 4-week training intensive, in the process and mindset training intensive, is that you got to trade through 2 periods of drawdown, as Dave said earlier, of a minimum of 10%. So we are enforcing within a group environment for you to experience pain. And it's a discomfort zone for you to go through that discomfort zone, get familiar with it, become comfortable with that discomfort zone, come out of it like exactly what's happened. Yeah, this is only a 5% drawdown, and I'm sure people who are on the study group might have had some second thoughts and some challenge. Their current belief system would have challenged them as to whether does this work? Should I stay in the flow? This is uncomfortable. That's only half of what we are saying you should do. So we haven't got to the 10 yet, 10%. And then we want to go through a second one. So we are saying 2. Now, this might take some time, but, it's easy come, easy go. The quicker you do this, the less time you feel experiencing that pain, the less it's going to actually be embedded into your new neural pathways and becoming your new identity. So it's going to take some time, I know, for some people, and we're getting some great feedback and comments and discussions on there. But, this is what it's about. It's not about, to learn the skills. It's not about, the profits. It's about embracing the discomfort zones and experiencing them, feeling them, and then coming out of them, like it's just like we're just showing there. Now, we're making a big thing about this, and we've gone a bit over time to what we normally do, but we're doing that because there has been some discomfort, and we're coming out and we're making new all-time highs, because you only register the end of that discomfort zone when you make a new all-time high, which is what the public portfolio has done. And the US has done it recently, and the leverage portfolio has just done it again, come out of a major, minor discomfort zone compared to the one it's had. But this is the time to talk about it. This is the time to raise it. So we got some real life examples sitting right in front of you for you to be able to empathize with these points we're making. Yeah. Okay, just to wrap up, the other LTTPs, let's talk about the US one, December 9.
So very zigzag at the moment, very
short.
It's a very, very short window that we're looking through. And again, you can see the randomness of outcomes, day to day fluctuations in equity curves. So there's not a lot of meaning that we can really attach to this at this point in time. So
let's just have a look here as to why. Now the grey line is the actual public portfolio. Where am I going to go? We'll just look at the number of trades because this is momentum. So you can do this number of open trades. Here we are. And you can see that there was less volatility in the equity curve because we were still getting into trades, and now we just got too fully invested, I think. Yep, and so that's where we are now. And there's Intel, 16%. And there was Baidu was down 7, still didn't give an exit signal. And there's also Lam Research had a 4% there. So that's the result. That's how this equity curve has just jumped and got ahead at the moment, but very, very short span of time. Yeah. And the other two, well, we can just mention that they're there. The US 3rd of February has only got very short period of time. It's just starting to get some trades into it. Yep. And the ASX 3rd of February is that one. Yep. Also just starting to get some trades into it as well. Yeah. So we're going to keep tracking these, and you're going to be able to see how they go. The September one's got a little bit of meaning in it, but the other three are still pretty short term. But and there's different trades, different mixes of trades in these different portfolios as well. But there are, there's over 150 odd customers that are in at least one of these portfolios. Some people are doing 2 of these, but I think this is the time to give a plug. Dave's going to be sending out some emails shortly.
Yeah, absolutely. So tomorrow you should all receive email just inviting you to register your interest for the next launch date. So we're looking for a start time towards the end of March, early April, just to give members enough time to get themselves organised, make sure that they've got a little bit of time to do some of the prerequisites, which is the 4-week intensive. So at least up to session 4, which covers the skills acquisition plan, because these portfolios are all based on the skills acquisition plan. They're skills acquisition plan portfolio. So it's going to give you a little bit of time to go through and do what is effectively about 4 hours work to get up to that particular level in preparation for launching at the end of March. So a big invite there for all members. If it's something that you'd like to do, be involved with, I encourage you very strongly. Put your hand up, let it be known, and we'll add you to the group.
Excellent. So I think that's it for today. Sorry about some of the technical issues we had there. And so we'll just finish up and say there's no questions. I think we've covered a lot. But just to say to you, we wish you consistent, objective, and peaceful, active investing.